We got Santosh Joseph, the founder of Germinate Investor Services, to talk about the last aspect, which is the implications for hybrid mutual fund schemes. Santosh, thanks so much for taking the time. Let me ask you this. With interest rates where they are right now, having been cut last week, and the possibility of another 25 basis point cut, what should investors bear in mind with respect to the return expectations from hybrids over the next 1 year?
Hi Alex, good afternoon. And it's good we are talking about equity hybrids, right? Hybrids as a category right now, because like you're talking previously on the show, with the reduction in the rate, everybody wants their home loans and the cost of borrowing to go down. Likewise, you also have to be practical to really tone down your expectation on the hybrid funds, because the breakup of hybrid funds is fixed income and equity. And with the fixed income, you had the scope of making returns on the capital appreciation thanks to the softening interest rate regime that you were in thus far, and maybe will continue for a short while from now. But from here on, because of large part of the capital gain or the softening interest rate regime being behind us, your upside is now not going to be much. It's only going to be accrual on the bonds and the fixed income you hold. So therefore, most investors who are coming into hybrids for the combination of fixed income and equity, within fixed income particularly, to make that extra sweet returns thanks to capital gains arising out of a softening interest rate, you have to tone down expectation and maybe drop it to some extent.
That's a good point. And by the way, in case you were wondering how this works, essentially, in the bond market, if you're holding an instrument that is more than 1 year, usually, and closer to actually 5 years or even 10 years, what happens is if the interest rates go down, then the bonds that you're holding become more valuable because the interest rate was already set before the interest rate cut if you're already holding that bond. And simply put, because you're holding that, suppose it was 100 rupees, it's gone up to 102 rupees to reflect the greater value. And so you make capital gains, which you only can get if you sell it. So that's simply put, right? And that's the fund manager's role in all of this, because the fund manager is balancing all of this. That's called duration. Santosh, now from that perspective, if you are to go out and buy these schemes, I've not really met a lot of people who advise that you go out and buy hybrids from the perspective of return maximization. So what should your process be in identifying what's good for you?
Alex, I think you nailed that. Most people come into hybrids largely to cushion their portfolio from volatile markets. Yes, there is going to be a combination of equity debt, when within hybrids you got the aggressive, you got the conservative, and you also have the all-weather BAF strategy. Going into it, if you're an investor starting today, you are getting into hybrids again for the same fundamental reason that you want to reduce the volatility, or let's simply put it, reduce the drawdown that one may experience in harsh equity markets. So therefore, when you enter into hybrids right now, irrespective of which category you enter in, you are now going to expect fixed income to give you stability, equity to give you that equity upside. Depending on the nature of fixed income, your stability may increase. But in the previous times, you would also expect fixed income to give you that positive return, like just you explain how the bonds become valuable when the rate cut happens. That propensity will reduce. Now it's going to be straight-jacketed. What is the bond bought at? What is the yield of the bond? Plus, what is the equity market upside possible? Therefore, anybody getting into hybrids right now will more or less try and expect a more normalized expectation of that hybrid, depending on which category you're going. So come in with that view.
Okay. And finally, I want to ask you about multi-asset funds, which are also essentially hybrid funds. But Santosh, they've gained a lot of popularity because they've been able to give investors the benefit of holding commodities, and specifically gold and silver. So any multi-asset fund that held between 10% and 15% in gold and or silver has actually had stellar gains over the course of the last 1 year. But it also has fixed income. So how do you understand what you should do if you are choosing a multi-asset fund, and would you suggest that investors look under the hood to see what our fund manager is actually doing before they make a choice?
Alex, you're absolutely right on that. Not every multi-asset is the same. You have to mandatorily look under the hood because there are multi-assets with static allocation, there are multi-assets with dynamic allocation following various models. So if you just take the last 1 year or 2 year where commodities like gold and silver are off the chart. In fact, if you look at the last 1 year return between gold and silver, both have done, one is at 75% return, one is at 90% return, and therefore any multi-asset with slightly higher exposure to commodities has done well, which means those people would have had a dynamic allocation. Any multi-asset which had a fixed of maybe 8 or 10% to gold and silver would have relatively underperformed that category, though doing way better than just the conservative hybrid funds. So multi-assets have proven the existence very well by diversifying into more assets than just equity and fixed income, which was the case in the previous times that you beat volatility by being in a hybrid. Now you're getting multi-asset, which is also a hybrid with the added dose, and the last 1 year, 2 year, 3 year returns look extremely good thanks to the way commodities have come into the play. But going forward, a diversified play to counter volatility, to cushion market drawdowns, multi-assets will play a significant role, but it's mandatory to look down the hood and choose your risk appetite. Do you want the allocation to be dynamic or do you want the allocation to be static? Because it will have a bearing on your outcomes.
Okay. Between a multi-asset fund and a balanced advantage fund, would you prefer the former, particularly for the longer time frames, or would you go with a dynamic asset allocation or balanced advantage fund strategy?
I am nowadays veering towards a multi-asset fund over a balanced advantage fund simply because the client does not have to add another line entry to add maybe a commodity or maybe a dynamic plane commodity. So I feel that multi-asset funds with the right proportion of equity, debt and commodities mix are able to even beat balanced advantage funds. And any fund that reduces volatility gives you the upside and gives you diversification and lets the investors stay consistently invested for long term is the winner. Because we all know staying invested is going to make you win. But which is the fund that is going to give you more comfort to stay invested for longer period is going to be the winner.
Right.
And therefore, I have a bend towards multi-asset funds.
Yeah, fantastic. Santosh, thanks so much for taking the time. Pleasure speaking with you as always. And viewers,
Thanks.
We've tried to give you some perspective on all aspects of what happens with interest rates going down and likely staying down for some time. Hopefully this has been beneficial for you. On tomorrow's program, we'll talk about your strategy if you have been contemplating buying a house and you've been wondering whether to bite the bullet. Is that the right word? We'll find out tomorrow. Do stay tuned. This is NDTV Profit.